9 times out of 10, my clients are pleasantly surprised when they realize, oh, we can actually buy something. And it's like, yes, I don't know where you're getting your information from.
Welcome back to another episode of the Tailored Property Wealth Podcast. My name is Casey Taylor. I'm the host of the podcast. And today we have Evan Reid from Neo Finance joining us for another episode. And in this episode, we are going to be talking about some client scenarios where we have mutually helped some clients go out there, purchase an investment property or multiple investment properties and really start to build their wealth. So welcome to the show, Evan Reid.
Thank you for having me back, Casey.
No worries, mate. Excited to kind of talk through, some of the client scenarios, how we've helped them, and just the power of really getting one, the purchase right, and two, the finance right. So you can just continue to build a property portfolio. Or some of the scenarios is rent vesting as well. And I guess where you're living, where you're residing, some people can't afford to get in there. And then as soon as you look nationwide, adopt that rent vesting strategy, you can get in and purchase and take some action. Cool. So the first client we're going to kind of talk about, there's a couple of purchases. So they're onto their third purchase with TPW. And the first purchase was in late 2022. That was a Brisbane purchase. Purchased it for $515,000 off market. Now, they were using a broker that they used at that time. And since last year when they engaged for a second, we've introduced them to Evan, and he's really been able to structure things in a way to keep building that portfolio. So you're able to kind of chat through, I guess, some of the finance side of things to be able to make that purchase last year possible. Yeah. We extracted some equity, and now we're going into and have ready for them pre-approval again this year.
Yeah, absolutely. So when I met with the clients last year, I think they had the 3 properties. So one owner occupied and 2 investments.
Yeah.
And what we did is we focused on, we know that their goal was to get their next investment property. You know, these clients are actively building a portfolio. And the biggest thing what we worked on was getting equity accessed out of their current properties that they own.
Yeah.
You know, they were sitting in a good position where their LVR was quite low, and we had the option where we could refinance, find a bank that valued these clients' homes a lot higher, move these properties, and then access equity to then get their next property. And that's exactly what we did. So it was a pretty easy transition. It did help that they had good income, good consistent income to back it up.
Yeah.
But overall, we were able to access, $200,000.
Yep.
Then we use that as a deposit so they could buy their next one.
Yep. And that's kind of the powering, like what we did with that purchase in 2022. They've made a massive amount of, I guess, capital growth, which allows you to leverage and go into another marketplace. And they reside in Sydney, and they have that nationwide approach to be able to really take advantage of different marketplaces early in their cycle, which is super powerful. And they're kind of now entering into, I guess, a rent vesting strategy themselves, right?
Correct, yeah. So they're in a position now where they've sold their own occupied, which is just going to help them continue to live where they want to live, in Sydney, not pay ridiculously high costs to purchase their place where they want to live.
Yeah.
But get in a position where they can just grow their investment portfolio, which is going to make them money.
Yeah.
And then in the next few years, if they choose so, move back into that owner-occupied space.
Yeah. Yeah, for sure. And so we made a purchase, the 2022 purchase one, I guess, early to the start of the year. That one's still to settle, actually, because it's a longer settlement period. And then got a pre-approval in place now to go.
We do.
into another state, another marketplace. So it's just powerful to get that finance part of it right and really build a portfolio quite quickly with the right structure, looking at the right lenders to be able to make that happen.
Yeah, and that's what we've done. We've got a couple of their investment, but last year when we refinanced them, we actually moved them over to a bank where they could access that 200,000, and they sacrificed having a lower interest rate. It did go up by a couple basis points, but we've already seen how that's been able to, build up their wealth, and their investment properties that they did buy last year have already grown in value.
Yep. Oh yeah, 100%. Yeah, it's real powerful. That one from 2022 has performed so well for them.
Yeah, well, I guess I had good foundations to work on when you introduced them to me.
Yeah. If you can thank me, that'd be sweet.
Thank you.
But yeah, it's getting the property purchase right and the finance right at the same time, and really knowing how to structure that. Super powerful. Cool. So the second kind of client scenario is a client who we helped purchase a couple of properties for last year, adopting a rent vesting strategy. And there's a couple of strategic purchases here that we were able to make happen. One was another purchase in the personal name, but then there was also the self-managed super fund purchase as well.
Yeah, it was.
Yeah. So are you able to kind of talk me through, I guess, a little bit of the finance piece for that one? Because we discussed this on previous episode, right? Not everyone understands that self-managed super fund space, but it can be quite powerful.
Yeah, so this client, when you introduced me to him, had 3 investment properties in his name, and was looking at purchasing a property under his self-managed super fund. And that was what he was using to help for his retirement as well. So you found him a property and we were able to fund it. He had a healthy balance in his super fund.
Yeah.
So at the time he had about 180,000 sitting in there.
Yep.
And we were able to use that as a deposit.
Yep.
So he could then buy one in his self-managed super fund.
Yeah.
And I guess the benefit to doing that is, they're not needing to use any of their income or any of their debts that they have in their personal name to service this loan.
Yeah.
And vice versa. If he's buying something in his personal name, we get to ignore that one that is in his self-managed super fund too.
Yeah, 100%. And that's just a real long-term approach. You purchase that property, you can't touch that until retirement, right? Until you're 60, unless you obviously offload it and sell it. But it's such a powerful play to be able to leverage your debt position to get a larger asset base within your super.
Yeah.
And then just let that compounding effect do its thing.
And then when he saves a bit more in his in his super fund as well, he's going to be able to buy the next one.
Yeah. Yeah.
So it's going to be beneficial to him to, build up this property in there.
Yeah.
So then when retirement does come,
yeah,
he's going to be setting himself up for a very comfortable retirement.
Yeah. And before I lead into kind of this point, this is not financial advice. Speak to your accountant, and all the rest of it. You cannot go out and leverage equity from that property in the self-managed super fund. That's something important to remember, because if people want to purchase, they might not understand that. So like you can in your personal portfolio, you can go out and leverage equity out of that one to go again. But there are, I guess, a lot more restrictions in that self-managed super fund space. So that's where it's really important to have the broker who knows what they're talking about, has the buyer's agent knowing what is possible with that purchase as well.
Yeah, and I think it goes back to that right team.
Yeah.
That we can introduce them to as well to make sure that they are set up properly.
Yeah, 100%. And that personal purchase that we purchased for them last year, I think it was July off the top of my head.
It was.
Yeah. So we purchased that for 555, 900 metre squared block. And that property's, it's now sitting in the high 600. So it's performed extremely strongly. And then there's a lot of opportunity to add value to that, whether a granny flat or even a dual lock. So you get that early capital growth, that equity, but then can come back later on and put some cash flow injections, some equity injections on it.
Yeah.
And it just continues to really ramp that property portfolio up.
Yeah, it does. And,
Yeah.
when we're looking at doing that, the granny flat play on there,
Yeah.
we can use that rental income
Yeah.
that they're going to be receiving, and that's going to help them just grow
Yeah.
their property portfolio.
Yeah. And they've now gone on to literally just recently settle on another purchase. So
Yeah, they have.
within essentially a 12-month period, they have been able to secure 3 more properties and continue to build their wealth.
Yeah.
And that's a pretty big achievement to be able to secure 3 properties in a 12-month period, right? Like
It's huge. And, I think it comes down to, them having that plan.
Yeah.
And just taking that fear away.
Yeah.
And knowing that the debt that they're getting into in their circumstances isn't a bad thing. They're building themselves wealth, and we've already seen the growth that they've had. You can't get that just by saving money in your savings account.
No. And this is, so many people get caught up in, I don't want to get into debt. The more debt I'm in, the worse off I am. But you can actually be in far more debt and be in a stronger financial position with cash flow, with your net wealth base. If you just more focus on building that net wealth base and focus on that, debt just becomes a lot less scary, especially when inflation devalues debt, and there's a lot of other things. And if you're purchasing in the right locations, LVR can drop even without paying any of that debt off, right?
That's true. And you've got to you've got to have that clear vision.
Yep.
Right. Because this is something that isn't short term either.
Yep.
And in this market where interest rates are still a little bit high, although they are coming down.
Yeah.
You've got to be able to sacrifice that couple hundred a week out of your pay to go towards it.
Yeah.
Because it is going to be negatively geared, the likelihood of it.
Yeah.
But in the long run, it's not always going to be like that.
No. And that's the thing people don't understand, right? It's like it's costing you now.
Yeah.
But as we see rental income growth, as rates improve, and yes, they're going to go up and down over 10, 15, 20 years. That's just the reality of holding property.
Well, I think if it's either going to cost them now or it's going to cost them their retirement.
Exactly.
It's
like, we'll just go and work until 65 and slog it out.
Yeah, where you could have the option at 40.
Yeah.
Exactly.
And so many people out there are saving really well. And another client we'll talk about, they have great savings surplus each month. It's like you might be saving $5,000 a month. And if it's going to cost you $250 a week, instead of saving $5,000, you might be saving $3.5, $4.
Yeah,
it's
exactly.
Like your cash surplus is still there, but you're now got an asset out there working for you, and it's essentially making money while you sleep, right?
Yeah. And then they're still building up their savings.
Yeah.
Building equity.
Yeah.
And then in no time, they're going to be ready to buy that next one.
Yeah, 100%. It's time in the market.
Yeah.
Time in the market's powerful. So I guess leading into that next client now, and that, so the last couple we introed to obviously you guys, and then this client you introed to us, and we've been able to go out there and help them purchase interstate again.
Yeah.
So I guess kind of talk me through their financial position.
Yeah. So this couple, good income, really good savings, had 2 properties already.
Yep.
So they're owner occupied in one investment.
Yep.
That they bought probably about 5-6 years ago.
Yep.
Had a lot of equity.
Yeah.
And they just didn't know what to do with all their savings that they had. They knew that they wanted to invest in property. Yep. They wanted to make their money work better for them.
Yeah.
And then that's when we introduced them to you, because they had the option with all this leftover income that they had. They don't have kids yet.
Yeah.
They don't have high bills. So they're able to put that money towards something which was getting another investment property.
Yeah.
And I think with him, with one of the applicants earning, good income with a lot of overtime, we're able to put that overtime to use.
Yeah.
So then that's when he's bought that next property that you helped him with.
Yeah.
And then they're looking at building a granny flat on the back of that too now.
Yeah.
Which is just going to give them a good income
Yeah,
once it's built.
that one, and I'll touch on that in a second. Just to go back to kind of talking about that overtime, right? Because there's a
Yeah.
lot of people out there that are getting overtime. Some people, sometimes you can use it, sometimes you can't. So you're able to tell me about how you kind of were able to take advantage of that overtime,
Yeah.
and kind of what's involved to be able to utilize that with, I guess, the different lenders.
Yeah.
Because like I said, there's a lot of people out there, and you can really take advantage of borrowing capacity.
Yeah. There's a few different ways to use the overtime. Depending on which lender you go through,
Yep.
you know, it can be varied. You know, some lenders will take 80% of it, some will take 90, some will take 100%.
Yep.
It depends on what industry you're in as well. You know, if you're in a professional industry, or, you know, you're in a government role where you're getting overtime, such as police officer,
Mm-hmm.
ambulance, or doctor, nurse, any of those things, we can use generally 100% of your overtime.
Yep.
But even if you're in, you know, you're working in the mines, or you're working in, you know, as a trader and you're getting that overtime, we can generally use majority of it as well.
Yep.
And it just depends, you know, we want to see that it's obviously consistent.
Yep.
But as long as you're actively receiving overtime each month, it's something that we can, you know, really utilize to help them buy their next property as well.
Yeah. And with that overtime, are there any restrictions on how long they have to be kind of generating that for lenders to take it into consideration?
Yeah, so if you're new to the role, you know, we want to see 3 to 6 months of that income coming through for the overtime.
Yep.
You know, if we can see consistently over 3 to 6 months that you're receiving it, then we can definitely use it.
Yep. Yep. No, it's good. I think that's just super important, because
Yeah.
some people think, yeah, it's a given you can use it.
Yeah.
So yeah, understanding that's super powerful, and it just bumps that income up, right? Based
it
on
does.
on your base. What about just a side note? What about if it's bonuses, and someone who is on a base salary based on performance? It might be like a sales role, and then they get some bonuses. How would you kind of look at that?
Yeah, as long as they've, you know, heading towards that 12 months of being at that one company.
Yep.
As long as they've received a bonus in that last year, we have lenders that will use 1 year.
Yep.
Same with allowances. They
Yep.
receive any allowances, whether that's car allowance, or you know, any other allowances that might be specific to their industry. We can use a lot of that as well.
Yep.
Commission's a good one. We can use commission if you've earned that over a 12-month period. So essentially, the idea is any pay that you're receiving, we've got lenders that can utilize a lot of it as well.
Yeah. Yeah. No, that's awesome. Cool. And with that commission, are they going to use 100% of that? Are they going to use 80%?
Like I said,
Depends.
some lenders, majority of the time, it's around that 80%.
Yep.
So it's still a fair bit, because overtime is a lot. But to take a bit of that conservative approach, we're generally looking at around that 80%.
Yep. No, cool. Good to know. Yeah, so just back to that property purchase for these clients, it's actually, so what we're looking at doing is a dual occupancy. So that is, they've secured a property on a 1,000-metre square block, and creating a dual occupancy at the back, 4-bed, 2-bath, and 2 garage. It can be a carport garage. And then it's not doing a formal subdivision. You don't need a DA, as long as we go out and it can meet a certain criteria on that piece of land. And that's actually going to allow a massive equity uplift once it's done. So valuations at completion are going to be like Circia 700K, and they're essentially, even worst cases, like 500 for the build and everything. It's going to be roughly like 450, but it's a massive play for that equity component. But then you're getting that cash flow as well, and the new dwelling constructed at the back is going to be positive cash flow once construction is completed and they get a tenant in, because it's generating about $650 a week in rental income. So it's a powerful plan, something we're implementing a lot at the moment, because clients who want to be aggressive can build that, create equity in a very short period of time that's really healthy, pull that equity out, go into another marketplace.
Yeah, and I think we had approval for that dual occupancy build
Yep.
within a week after settlement.
Yep.
So, you know, something that we're able to act on really quick for them as well.
Yep.
Which means that they're spending less time only having the one property on there
Yep.
to get that rental yield up.
Yeah. And that's important to note as well, because when I speak to some people about this strategy, that established property at the front is going to be rented out the entire time for the construction. It's just a matter of communicating that with prospective tenants on how it's going to be structured. And yes, there might be a slight discount with market rent. I'm doing it on one of mine at the moment, and you still get market rent for that front property and still be able to build that property at the back. And they're now looking at another purchase as well, right?
Yeah, they are. So, you know, once again, we've taken into account what it would be for the construction costs.
Yeah.
And they're still able to buy another one as well.
Yeah.
And, you know, these people aren't earning hundreds and hundreds of thousands.
Yeah.
You know, they're just normal incomes.
Yeah.
Good incomes, good overtime, but they're actually...
It's achievable, right?
It's achievable.
Yeah.
You know, and I think there's a lot of perception out there, you know, in the media that you can't buy property. It's hard to achieve. You can't do it.
It's
but
possible.
you just haven't had that conversation.
Yeah.
Yeah.
And as soon as you look nationwide,
Yeah.
there are so many locations that are still affordable.
Absolutely.
And it's just opening their mind. Everyone wants to buy a property around the corner from home to make sure it doesn't run down the street or whatever it is. That's what you've got a quality property manager for. As soon as you look nationwide, there's so many options out there, so much more affordable as well.
Absolutely.
So
and so much better return on rent.
Oh, yeah. Yeah. And that's a thing, right? It's balancing.
Yeah.
Balancing that rental return, because like for us here locally in Newcastle, like the rental returns aren't as strong as some other locations.
No.
Yeah. And property's more affordable, but you're still not sacrificing on that growth if you know where to look. Yeah. Cool. And then I guess one more client to touch on is a rent vesting strategy. They'd saved a decent chunk of cash, but couldn't afford to invest in the Sydney marketplace.
Yeah.
So you're able to kind of touch on what their budget was, and then I can, share what we did with them with that purchase.
So when I met with this client, he was actually adamant that he wanted to buy a place to live in.
Yeah.
You know, take into account the first home owners grants, the government grants that they had.
Yeah.
And he wanted to buy a place that was around where he lived. And, you know, no property around him was under 800,000.
Yeah.
You know, even something that needed to basically be knocked down was around 800,000. So, you know, and then looking at his borrowing to purchase something for him to live in, you know, the max he could borrow was at 400. So, you know, we quickly came to the realization that, you know, for him wanting to buy property, wanting to get into the market, and mind you, this client is only 20 as well, right?
Yep.
Basic income,
you
know, probably around that 60 to 70,000 a year.
Yep.
And he was able to buy a property that you helped him with for a couple $100,000 more than what he could have bought if it was an owner occupied. And I believe after settlement, you know, you were able to help him increase his rent by about $70 a week. It was.
I can't remember the exact figure now.
I'm pretty sure it was 70.
Yeah.
Yeah. I think it started at 450.
Yeah, yeah.
And then a couple of weeks it went to 520.
That's right. Yeah. So that purchase, they had tenants in place under market rent.
Yeah.
And this is something we see a lot. It's frustrating, but that's where you can eliminate some of the owner occupiers that emotionally purchase a property. But yeah, it was increased from the 450 to 520. And this build as well isn't super sexy. It's a bit of an ugly duckling, but it's on a 770 metre squared block. Again, granny flat play, dual occupancy play options in the future. And that property we secured prior to auction. And so the median value of this suburb that we purchased in is just under $800,000. We secured it for $565,000. So there's just so much room under the median price point that based on valuations is going to give that uplift. And I think it's already done about 70, 80K.
Yeah.
And that settled, I think it was September, October last year. So it's not even 12 months.
I've done an evaluation recently and it has grown.
Yeah. So and this is the prime example, right? So many people say it's too fucking unaffordable. I can't buy. Victim mentality.
Yeah.
It's like, as soon as you don't look just in your backyard, you look nationwide, there's options and you can still get performance. And yes, it doesn't mean you're going to get your own occupied property today. It doesn't mean you're going to get your dream home. However, if you play that game, there's options out there and you can continue to move forward.
Exactly. And that client, when we did his loan, it started at a 6.9% interest rate.
Yep.
We've already had 2 rate drops, you know?
Yeah.
So it's still sitting on the lower side of closer to the 6% now.
Yep.
Which has just really helped him.
Yeah.
And us actively reviewing his interest rates, you know, every 3 months.
Yeah.
That bank's also come down a few times with their rate as well.
Yeah. It's awesome. And with that performance, with the LVRs dropping, even interest only, that LVR is still dropping, and that just gives you more options lending.
Exactly.
So it's super powerful.
And that's the other one that I wanted to touch on as well is, you know, we've got options with, you know, either paying principal and interest or interest only.
Yeah.
So, you know, you once again, bit of a higher interest rate for interest only, but you're still paying a lot less. That if you've got your own occupied, you're putting it back into that property that's not benefiting you any way possible, because owner occupied properties are not assets.
Yeah.
You know, so you've got so many different options to make sure that, you know, you're leveraging the property buying, but also not completely parting way with every single dollar that you have to.
Yeah, 100%. I actually spoke to a prospect recently, and this is the kind of example you've just touched on. So they've got an owner occupied. They were looking to purchase an investment property.
Yeah.
But once I say, look, the reality is it's going to cost you to hold $250 a week. So they said, we can't afford that, but what we're going to do is upgrade the owner occupied property. That debt, that additional debt, isn't generating income.
Nope.
So you can't then claim any depreciation or any of the interest or repayments. So this is what people don't understand. Your owner occupied debt is actually worse for cash flow.
Yeah.
Yeah, don't get me wrong. Purchasing your owner occupied is great.
Yeah.
But if you're doing that because you think you can't afford to hold an investment property, it's actually more beneficial from a cash flow perspective because you got the depreciation benefits, you got the tax benefits. Again, speak to your accountant. But it's that education piece, right? But some people, they don't listen. They acting emotionally and want to purchase that owner occ.
I think we're just there to take their money.
Yeah. And look, sometimes where they are with the owner occ, that property might not perform that well over the next 5 years, right? Whereas that investment property in an area prime for growth is going to build your wealth in a far more powerful way. And you don't have to then sell your owner occupied property to get some of that wealth.
Exactly. Yeah.
Be asset rich.
Yeah.
Cool. Well, it's just a couple of scenarios of some of the clients we've helped. It kind of just allows people to understand that you don't have to be on $500,000, $600,000. You can do this on modest wages or even just strong incomes that aren't crazy.
Yeah.
But it's just changing that approach, finding solutions, and you can change your financial future. It might not mean you have 20 properties. It might just be a couple, but that into retirement is going to massively change your financial position.
Exactly. And don't listen to someone that, you know, hasn't bought property since 1975.
Yeah.
You know?
Yeah.
Speak to these experts, speak to people that are doing this every day.
Yep.
And honestly, 9 times out of 10, my clients are pleasantly surprised when they realize, we can actually buy something. And it's like, yes, I don't know where you're getting your information from.
Yeah. Yeah, and that's a big mistake people make. They listen to their uncle at the barbecue with the wife beater on.
Yeah.
Property investing doesn't work. And it's like, okay, so how many properties does he have? Oh, he's bought his own occupied property in 1972.
Yeah.
It's like, why the fuck are you listening to that guy?
No, you shouldn't be.
If he knew what he was doing,
he
he'd have 20 properties and be telling you to purchase. So
Yeah.
it's
And not only
be
that,
careful
his
here.
scenario is a lot different to everyone else, you know?
Yeah.
So it's, I mean, get advice from the right people.
Yeah. It's powerful. You want to take advice from people who are in a position that you want to get to, right? Because
Correct.
if they can get there, they've got knowledge that you can take on
Yeah.
and really benefit from.
Yeah, exactly.
Yeah. Well, cool. Thanks for jumping on to another episode, and we'll see you guys on the next episode.
Thank you for having me again.
Bye.
Gotcha.